Thanks for joining us today on Market Call. I'm Morella Fernandez. Andrew Moffs on the show. He's Senior Vice President, Portfolio Manager at Vision Capital. He will take your question today on real estate stocks. Here's how to reach us, 1-855-326-6266 if you want to give us a call. You can also send us an email today, marketcall@bnnbloomberg.ca. There's the information. And Andrew joins us now. Good to see you. Thanks for joining us today.
Yeah, thanks for having me.
So recent rate changes we've seen, I'm wondering if that has affected REITs.
Certainly, there's a lot of focus on interest rates. The biggest thing we find in our business, it's about the stability of interest rates, less about the direction. And what we've seen actually in the past 6 months, we've had greater stability in interest rates. And what it is allowing to occur is a more transaction activity starting to pick up, which I think will lead to price discovery in our sector, which gets us bullish on 4 key themes, which I'm happy to dig into.
Okay, we'll talk about that a little bit. I'm wondering, with the focus on tech and everybody wanting to pile into AI stocks throughout the year, I'm wondering whether you have seen REITs come off a little bit.
They have. I was actually looking at a chart yesterday. If you look at real estate stocks in the S&P 500, they are at their lowest levels on a valuation basis relative to the rest of the S&P 500. This is a group that's really been underloved, as there's been a big chase, as you've talked about, in tech and telecom, et cetera. And as a result, you have great businesses, that great store of value, with growth themselves completely being overlooked. And what we love about our sector is we look at the private market. The private market dwarfs the public market. And right now, we see our sector, the real estate public security sector, trading at a very wide discount to what we call the net asset value, the private market. So we think there's going to be a lot of opportunity heading into 2026. This is the typical environment where one can imagine M&A activity picking up. So I think this is a great time to be looking at the space today.
Okay, you've also, I know, looked at dividends year to date. What have you noticed?
Sorry, we've looked at dividends?
Yes.
Yeah. So, when you look at our sector, dividends are growing, which is a great thing. We've seen some Canadian REITs, for example, think Crombie, think Automotive Properties REIT, actually increase their distribution for the first time in years, almost since inception. That's because the property fundamentals are so strong. So they have no choice but to increase that distribution to unit holders. I think it's a very bullish sign. We're total return investors. We really care about what is the value of the enterprise going forward, but it is always a great sign to see that the cash flow is increasing, and that ability not just to retain cash flow in your business, but then to pass it on to unit holders is very positive.
All right, we will take a quick break. We'll line up some phone calls and emails for Andrew Moffs of Vision Capital, taking your questions on real estate stocks. We're back in a moment. Welcome back to Market Call. Thanks for joining us. We're going to start with an email for Andrew from Chris. This says, with EREUN winding up, what would you suggest as a replacement for European or global REIT exposure? Do you look at other outside of North America REITs, Andrew?
We do. We focus on North America, but we do look outside of North America on a select basis. And today, one of the big opportunities we see is in Europe in the industrial warehouse space. We own 2 REITs, Segro and Tritax Big Box, ticker SGRO on the London Stock Exchange, and B-Box on the London Stock Exchange. These are 2 industrial warehouse REITs that are heavily discounted, and a great opportunity to be looking at that space.
Okay, have they worked the same way we've seen REITs with that sort of that lower value at this point because people are looking at tech? Has that worked in Europe as well? Is that the way it's going?
The issue today is specifically in the United Kingdom is that they've seen a big increase in interest rates. The Bank of England, kind of has its hands tied. And as a result, you've seen 10-year gilts, the measure over there for their 10-year bond, move higher. As a result, that's seemingly put pressure on cap rates, the going-in yield of these assets. We think that discount, that overhang is far too much. And as a result, these stocks are trading at very wide discounts to net asset value.
Got it. Okay, let's get to another email. This one's from Stuart. He says, could Andrew please comment on Slate Grocery REIT, SRG, UN. Is the monthly dividend safe with a present payout ratio? Do you off the top of your head know what the dividend is for SRG?
It's quite high. Typically, that is a red herring. Basically, suggests to you perhaps the enterprise can't sustain that distribution from its cash flow, and that is really the case today with Slate Grocery REIT. I think it's what we call their AFFO, their adjusted funds from operation. Their payout ratio is above 100%. That's not a good thing. It's probably north of 110%, quite frankly. What they've seen is they've had some temporary vacancies in some of their larger boxes. So this is a REIT in the United States that focuses on grocery anchored shopping centers and more secondary markets. And one of their boxes has gone vacant. As a result, cash flow has gone even more negative relative to distribution. And we see the combination of a very high distribution payout. So we think, in other words, the distribution should be cut, as well as elevated debt levels. I think there's better opportunities if you want to play that space.
Got it. Okay, let's go to the phone lines. John's on the line from London, Ontario with a question. Hi, John.
Hi, Marilla. Thank you, Andrew, for Chartwell. I did add to it, and it's knocking on the $20 door, so thanks for that. Allied Properties is an example of a stock that is not exceeding its dividend payout ratio, and it's paying a 9% dividend. It's actually above water now for me, which is nice to see after a year and a half. What do you think of Allied Properties for another 2 to 3 year hold? Thanks very much.
Okay, thank you for the question. Allied Properties, we'll pull that up in a moment. What do you think of Allied Properties? They invest in office properties, I guess, across Canada. I know there's been trouble trying to get people to go back to the office and the use of the office space.
Yeah, the return to office mandate is picking up. It's real. I think we see over 2 million square feet being affected positively here in downtown Toronto in terms of activity levels. But the reality is the market's more like 100 million square feet, so it's only 2% of the market. Allied Properties has good properties spread nationally with concentrations here in the Greater Toronto Area, as well as Montreal, Vancouver. The stock has benefited. To the caller's point, it's benefited a lot due to sentiment, yet we're not seeing it translate to operations on the ground. We have a balanced view on office. Any thoughts on Allied are more specific to the entity than a return to office sentiment as well, because that's really what's pushed the stock. The stock's now been pushed to a level where it trades above, about 10% above consensus net asset value. At Vision, we look to buy stocks trading at a discount to net asset value. At the same time, the supply and demand fundamental picture is still not that great. If you look at the downtown west office market, it's still 30% vacant. And so you typically need 10% vacancy to have pricing power as a landlord. As it relates specifically to Allied, that distribution that the caller quoted, perhaps, I was reading some recent research from Desjardins, and they talked about how the distribution levels are actually not covered. And though Allied is on a path, a target towards 90% occupancy, they're only 85% occupied now. They also need to close on condos at a project called King Toronto, and they also need the repayment of a large loan, $240 million, from developer Westbank that they had lent money to. All these things together will help reduce that distribution coverage, but there's no way that at least Desjardins sees, and we tend to agree, that they can hit their goals for debt reduction as well as occupancy levels by year end. So we think the stock is ahead of itself. And if you're looking to play names in the office space, we think there's better opportunities, perhaps in the United States.
Interesting. Okay. Are you finding generally, based on your last comment, that there are better opportunities for REITs in the U.S. versus Canada? If so, generally, why?
It's really stock by stock. What people don't realize is that there's 16 different property sectors within the REIT index. So actually, we're quite bullish on seniors housing, for example, and we'll talk about that later in the show. But we see more value on the Canadian side than on the U.S. side. Both have great fundamentals, but the valuations are cheaper here in Canada than the United States. On the office side, we see better opportunities specifically in the United States, only because we see some great markets like Manhattan, where return to office has been real. Fundamentals are strong. There's pockets of New York City where you have 5% vacancy. I mean, that would be a dream here in Toronto, for example. Yeah.
I always wonder about the disconnect, why some things work one way there, and the exact same influences are happening here, but working very separately when it comes to sort of people getting back to the office. Okay, let's go back to the phone lines. Terry's on the line from Edmonton with a question. Hi, Terry.
Good day. My question's on SmartCentres REIT. Is this a good investment going forward? It's got a good dividend or that at 7%. And tell me about it. Thank you very much.
Okay, thank you for the question. SmartCentres REIT, so they are retail stores, and I'm just wondering how you're looking at the retail space, first of all, in general.
Yeah, it's funny. I talked about 16 different property sectors and retail being one of them. But then you can really bifurcate within retail. Is it enclosed malls? Is it necessity-based grocery anchored shopping centers, which we really like? Or in this case, is it more power center, open air centers where the boxes are typically leased to general merchandise retailers? I think in this case, Walmart is their principal tenant. Great retailers like Dollarama, PetSmart, TJX, so the Winners brands, et cetera. So that's what SmartCentres owns. Hence, it's very defensive. That distribution is high as a result. And the flip side of it being defensive is that in this case, because the occupancy levels are so high, there's no growth. I shouldn't say no growth, but very little growth, in fact, below inflation growth. So you typically see this growing about 1.5%. And at a time where they have higher leverage than they would like, you're not seeing enough of it translate to the bottom line in terms of earnings potential. We think there's better opportunities in a very strong retail landscape for some other entities, and we tend to focus more on the necessity-based shopping center side as a result.
Got it. I guess the close to 7% dividend is what is enticing people, right? And wondering sort of what the future is there. Okay, we're going to take another break. We're going to line up some more phone calls and some emails for Andrew Moffs of Vision Capital. Again, he's taking your questions on real estate stocks. Back in a moment. Welcome back, and thanks for joining us here on Market Call. John is on the line. He's in Hamilton, Ontario. Hi, John.
Oh, hi. Thanks for taking my call. I'm a dividend investor. I like focusing more on income rather than growth. With that in mind, I do invest, and I like the senior housing market, which it sounds like you're going to talk about later. I have Sienna, Chartwell, but I wanted to ask you about Extendicare. And your feelings around that, if there's an upside. It does pay a dividend. Unfortunately, it's not eligible for the dividend tax credit, like many of these are not, except for Sienna. But other than that, what's your take on Extendicare, if I could get that from you? Thank you.
Okay, thank you for that question. Andrew, are there key differences when you look out the space for senior care?
There are. There's different ways to focus on senior care. One end of the spectrum is 100% private pay retirement homes. The other end of the spectrum would be government-funded long-term care facilities. And then there is a growing sector being, of course, the home healthcare business. Extendicare plays in both the long-term care segment as well as the home healthcare business. Their business on the home healthcare side is called Paramed. Extendicare traditionally was only focused on long-term care facilities. So these are nursing homes principally in Ontario. You have the credit basically of the Ontario government, a AA credit. There are something like over 58,000 people waiting to get into a wait list, waiting to get into these beds. So there's no risk on the earnings side. You really have to manage it on the margin side. And Extendicare, like its competitors, are very good at doing so. The reality today is Extendicare's business is only about 45% in that business, and the home healthcare side is what is growing. This is a very different business. It's asset light. It's not real estate. Hence, you're going to see the dividend not be as enticing as you will with other names. This is a business a little outside, I don't want to say outside our scope necessarily, but what they are doing is paying low multiples for home healthcare businesses and ascribing a higher multiple to it in the public markets. We're more net asset value investors where we can buy, where we can value the brick and mortar. You can't really do this in this business. It is a good business. The demographics are on its side. For us, we focus more on names like Sienna and Chartwell.
Got it. Okay, John, I hope that helps you out as we move on to another caller. Moez is from Vancouver. Hi, Moez.
Hi, good morning. Thank you for taking my call. My question is on Crown Castle, the American Tower Company. Now, it has sold some assets, but I understand that still it has a very high level of debt. What is your opinion about this one, please? Thank you.
Okay, Crown Castle is their real estate investment trust. What do they own and operate? I have towers here for wireless communications.
That's right. They own and operate cell towers in the United States. They're one of the largest publicly traded REITs. It's really an oligopoly business where there's 3-4 major owners of these cell towers, and there's 3-4 major cell service companies. So as a result, it's typically imbalanced. Today, it isn't. What you're seeing on the operator side is what we call churn, where one of the operators is coming off of cell towers, and they're going to have to lease up that space. This is as a result of trade competition. And one of the other risks to this business that make it hard to underwrite from a demand perspective is a lot of people are wondering, what does satellite connectivity do to cell towers? Does it make it on the margin somewhat obsolete?
I was going to just ask you that because there are more and more of these low orbit satellites going up, right?
That is correct. I mean, cell towers have done a great job of insulating their business over the years. If you think back 20 years ago, it was about pagers going away. What would happen? Then, we had cell service, then we have 2G, 3G, 5G, et cetera. So there's always been a growing case for cell towers, and hence it's been more of like a utility, and hence infrastructure like and defensive. But the alternative use of the real estate is not really there. So it's more, if anything, I think of this space as more of taking advantage of a tax code and the ability to not pay dual taxation by paying out your income through dividends. And as a result, we haven't really focused on this business. We think there's too many demand headwinds in the near term.
Okay, good to know. Thank you for that. We're going to move on to another caller, Deborah, who's calling from BC as well, Okanagan Falls. Hi, Deborah.
Hi, good morning. Hi, my question today is on Boardwalk Real Estate, BEI. I bought at the $53 range. I think the dividend yield, going from memory, is just over 3%. Now, it's fallen significantly from its high, and I'm thinking maybe I should have sold. So my question today is, where do you see this one going, and do you hold the stock?
Okay, thank you for the question. I have dividend around 2.4. Does that sound right to you, Andrew?
Yes. Okay. It's a lower yielding stock, and by design, and I think it's a wonderful thing that it is. We do own Boardwalk. It's actually the only multifamily REIT operating in Canada that we own. We think very highly of the management team, but why do we focus on Boardwalk? 72% of its net operating income come from non-rent controlled markets. So in Alberta and Saskatchewan, both those markets operate as free market provinces, and hence there's a nice balance between demand and supply. Boardwalk, where a majority of its portfolio is in Alberta, benefits from in-migration, population growth going to what is really an affordable province. If people are looking for jobs and a place to live, the province of Alberta, cities like Calgary and Edmonton provide that. And Boardwalk itself provides a great product. And so this is a name I think is a great entry level for many because it's trading at big discounts to net asset value. We think it's worth north of $88, and it's a great level to be buying in today. So when I say it's a good thing that the dividend is low, the distribution is low, it means they can retain the cash flow that they earn, either go out, either buy stock, which they've done a good job of doing, buy more assets, or more importantly, also just invest in their asset base. Real estate's a capital intensive business. You have to keep your properties up to date, both for safety, but of course for enticing new residents and residents to continue to renew their leases. So I would look to be buying Boardwalk here. As I said, it's a big position for us in our fund.
And you said you have a price target of 88, is that right?
Yeah, when we do our net asset value work, it's not hard for us to get in the high 80s.
Right, and it's trading at 68.50 about today. All right, we do have to take another quick break. We're going to be back and have a look at past picks from Andrew in just a moment. Stay tuned. Welcome back to Market Call. Let's go to past picks from Andrew Moffs from October 31st last year, Halloween. They weren't that scary, though. First Capital was the first pick, Andrew, last year. Recommended at $17.78, now up to $19.42. And it's a 10% upside return and a 14% total return. They do mixed urban real estate. Is it generally housing that they do, or is there something added to that?
No, this is grocery anchored shopping centers.
Got it.
In fact, 86% of their income come from either grocery, from pharmacy, or services. So very recession resilient, tariff resilient. We think they own the best corners in the major markets across Canada. There's no fashion in any of those types of centers, and very defensive. The flip side is there's a lot of growth to this business. In fact, they're operating at occupancy levels record high, 97.2%. They've been able to renew leases at really high levels above historical averages. Historical averages, you typically renew a lease 9 to 10%. They're doing them at 16%. So we see, as a result, they've been able to increase their same property net operating income forecast for the year. And we see a lot of growth in this name at a time where the stock trades, even though it's done quite well. We still think it's worth $22, their own IFRS net asset value estimate. So we think there's still a lot of good upside here with great growth.
Is it something you still own?
It is something we still own. In fact, it's one of the biggest names in our fund.
Got it. Okay, let's move on to your next past pick, which was Chartwell Retirement Residence, which we did touch on the sector a short time ago with a caller, but Chartwell Retirement, how do they work? They are up 30% return, total return of 34% from the time you recommended it last year. They're at $20.40 today.
Yeah, and a stock we continue to own. Typically, when a stock does that well, it really closes the gap to net asset value, which is you've heard a few times now, our kind of North Star. What we love about this business is that North Star keeps moving. Why? Because there's phenomenal growth in the seniors housing space today. Chartwell operates only in the retirement sector, where again here, this is a great sector because you're seeing the senior demographic, everyone is well understood at this point. The population growth of that seniors is going to far outpace the general population growth rate at a time where new supply has fallen off a cliff. And so typically we've seen new supply really hold back the ability to push rents in this business. So Chartwell's on a track to 95% occupancy. They're at 93% occupancy currently. They're been able to acquire $1.3 billion of retirement homes this year. They're doing so in a very accretive manner. So we think their capital allocation is excellent, and we continue to see great growth in this stock over the next year.
Is this a company that is across Canada or only certain provinces?
Only certain provinces, Ontario, Quebec, Alberta, British Columbia.
Okay. Let's move to your third pick from October, Halloween last year. At the time, it was Empire State Realty with $10.60 US in New York. It's down to $7.63. And it's a dropped return of 28% or 27% for total return. Now, they do the retail, office and retail space. New York, Connecticut, are they focused on the East End? And if so, what has happened in this market that has driven this stock down?
Yeah, so they are principally an office landlord, and they only operate in one market, and that's the greater New York City market. Their main focus is Manhattan. They have had some exposure north of the city as well as in Brooklyn. But their biggest asset is the Empire State Building, which is a phenomenal office asset. But it also encompasses the observatory, which contributes about 25% of the income of this vehicle. First of all, taking a step back, we're bulls on the office business in Manhattan. I talked about that earlier, and we thought Empire State would be a good way to play that. The reality is, and what we realize and why we no longer own this stock, is that there's a bit of a negative sentiment and overhang to travel to the United States, and as a result, that's affecting attendance at the observatory at the Empire State Building. We saw net operating income at that asset go down in the second quarter. It was actually more weather related than travel, but it's more the sentiment that's been an overhang on the stock. And sometimes when the sentiment is difficult to fight, we look for other opportunities, which we have in other names in the New York office space. Interesting.
So it's a hit on tourism for the U.S. We know a lot of Canadians have been banning going down as a result of some of the policies introduced. Okay, Andrew, we're going to leave it here for your past picks. But when we come back, we'll take more phone calls and more emails for Andrew Moffs of Vision Capital. We're back in a moment. Welcome back to Market Call. Thanks for joining us. Andrew Moffs is with us, and we are going straight to the phone lines. On the phone, we have right now, let me double check, Claude. Claude, what's your question today?
Hi, thanks for taking my call. I need Andrew's opinion on Artis. I've had it in my portfolio for quite a long time, and it's not been doing very well, except I've held on to it because of the dividend. And I need your opinion on what your thoughts are. Thank you.
Okay. Andrew, this is an investment trust that owns properties out west. Is that correct?
Yeah, so it's a diversified REIT. It owns across several property types, office, as well as retail, industrial, and different geographies, both in the United States and in Canada. It's been going through it had gone through a strategic review, I think, north of 2 years. And unfortunately, they just came out with an announcement that's with a very challenging transaction that, if it's consummated, would be effectively selling Artis at a 44% discount to their own IFRS NAV. As part of this, I don't know if the caller appreciates, but they've done something which I've been talking about for a long time. Every time I get asked about this name, is that they've cut the distribution. Something I kept highlighting, that it was something that they were over distributing, and it was necessary for it to be cut. So that distribution is going down. What used to be a monthly distribution will soon be a quarterly dividend at a much lower rate. And what have they done? They are merging with a related entity. Their chairperson's subprime lending company. They're paying effectively what we calculate as a 14 times multiple for an alternative lender, which is above the multiple of Royal Bank. Doesn't make a lot of sense to us. And you're not getting the true value of the real estate for Artis. So I think it's a really disappointing outcome for unit holders. It's very difficult to recommend this. There's very little detail as it relates to this merger. We look forward to seeing the circular when it comes out to see where we may be wrong. But as of now, I definitely think this is a name that should be avoided.
Good to know. As we move on to Anita, who's calling from Markham, Ontario. Hi, Anita.
Hi, good afternoon. Thank you so much, Marilyn. My question is on CT REIT. I've been holding this for some time, and I don't see much growth in it. I think the dividend is 5.8 or something like that. Your thoughts on this, please, Andrew?
Okay, thank you for that question, Anita. CT Real Estate, so they do income-producing commercial properties. What kind?
So they own the real estate of Canadian Tire. So think of this as Canadian Tire REIT, where 92% of its rent comes from Canadian Tire, and Canadian Tire owns about a 70% interest in the enterprise. As a result, very stable. So to this caller's point, there isn't a tremendous amount of growth, nor would one expect it. You have a very safe, stable distribution, just south of 6%. And, figure you can get to 3% growth out of this entity. We've seen, I think, low 2.2% internal growth on the top on the net operating income line, and probably translates to about 3% bottom line growth. I think that's all you can ask for an entity like this. I think they do some interesting transactions here and there. They for instance, they bought a nice center from Primaris this year. They've announced the redevelopment of an office building with their partner Oxford, their headquarter building at Yonge and Eglinton in Toronto. So I think the stock price really translates into one thing: stability and confidence that that distribution will not be cut. We think pretty highly of the management team and what they're doing.
So you would hold at this point?
Correct.
All right. Anita, I hope that helps you as we move on to Debbie from Burnaby, BC. Hi, Debbie.
Hi, I'm just calling about RioCan, REI REIT, and I'm wondering if there's an upside and how safe the dividend is. I'll hang up and listen. Have a great day.
Thanks very much for the question. RioCan REIT, we will see if we can pull that up. So again, shopping centers. And I know you had initially talked about the different kinds of shopping centers and whether or not they've come back since COVID. Tell me about RioCan.
So RioCan principally operates in that open air shopping center space, grocery anchored shopping centers, very good management, where they have investments outside of that core business. They own a few enclosed malls. They have an entity, part of their business called RioCan Living, where they developed multifamily assets, principally in Toronto, but also outside of the GTA, which they're presently selling, as well as they had a partnership and investment in Hudson's Bay Company, which of course we know has gone through a bankruptcy process. So the combination of selling down multifamily at a time where rental rates are contracting on the apartment side in Canada, and the combination of owning enclosed malls linked to Hudson's Bay and having to deal with boxes that are leased to Hudson's Bay when they've now closed all their stores has presented a bit of an overhang on the stock. Notwithstanding all that, we think the distribution is quite safe. They are going to have an investor day conference in November where hopefully they can tackle some of these items and talk through it and talk about the growth picture, which we think can be quite bright for RioCan. So it's a name, if you own it, I would continue to hold it. I'm not concerned about the distribution, and I think they definitely have some good levers to pull in terms of dealing with some of these overhangs.
Yeah, and a decent dividend, 6%. For RioCan. All right, Debbie, let's go to William on the line, London, Ontario. Hi, William.
Good afternoon, and thank you for your past suggestions. I'm wondering if I should keep investing in Northwest Healthcare.
Okay, go ahead, Andrew.
Yeah, so Northwest Health, we call it a show me story. They have a new executive management team, and that its new CEO is charged with overhauling this REIT because it's definitely in need of an overhaul. They own quality assets, but they're pretty disparate in different geographies globally. And so they are on a path to exit Australia, perhaps exit Europe, perhaps exit Brazil, all to then focus on Canada and the United States, where they own healthcare assets like medical office buildings and hospitals. So you're going to see a lot of churn in that portfolio. You may not see the earnings growth because that might be a bit of a dilutive exercise as you sell assets when perhaps the market isn't willing to bear the best price for it today, to then reinvest in a sector that's continues to be pretty resilient in North America. So not a name that's been a big focus of ours because we haven't seen the growth that we typically like to see when we invest in these enterprises. And so we call it a show me story. And I think CEO is quite talented, and hopefully they'll be able to execute.
Andrew Moffs of Vision Capital is taking your questions today on real estate stocks. Our last block of callers coming up. Stay tuned for that. Back in a moment. Welcome back. Let's go to Mike on the phone line in Delta, BC. He's got a question today for Andrew. Hi, Mike.
Hi, Morella. Thanks. Andrew, I was wondering if I could get your thoughts on Choice Properties. I like it because it has a mixed bag of properties, but Loblaws is its principal tenant, 5.3% dividend. Do you own it, and do you like it as a long-term hold? Thanks for taking my call.
Thank you for the question. This is trading currently at $14.54, down a little bit on the day, and down a little bit on the year, down 3.7%. Andrew, do you like Choice Properties?
We do. Choice is a really good company. Its principal tenant is Loblaws. 70% of its business is in the retail space, 25% in industrial, which is a sector we really like, and then they also own some mixed-use residential. To balance that out, the stock typically trades at a nice premium multiple because it's defensive. It has a great balance sheet, solid management. And as a result, because of that premium, that stock price is getting much closer to net asset value than some other opportunities in the retail space. I think NAV is probably in the low $15 range, perhaps $15.25, $15.30. And so you still have a bit of upside to go there in terms of closing the gap. You earn about a 5.3% distribution yield, if I remember correctly, and it has nice growth. So really a very safe name to own. I recommend it to lots of people in terms of if there's a stock to own that they're just looking for safety and distribution, you can find that in Choice.
All right, Mike, I hope that helps you as we move on to Gordon, who's calling from Victoria in BC. Hi, Gordon.
Good morning. Crombie REIT has a collection of Safeway properties in Vancouver. They're in various stages of densifying them with residential units. They're terrific properties, but are these projects still on track given the rather alarming state of the Vancouver condo market?
Very good question. Andrew, we know the condo market's been really badly hit in Toronto. It is being hit in the BC capitals as well. I'm wondering what you think of the space moving forward, especially if Crombie sort of has already investments at hand in the condo market.
Yes. So to be clear, Crombie, which is a shopping center owner, they own principally brands related to Empire, hence the Safeway grocer chain in out west, where they develop residential. It's purpose-built rental. And they actually have a very successful purpose-built rental, which I've toured in the past in Vancouver. And what we like about Crombie's business and the shopping center space generally is that we think of these as covered land plays, meaning you own land, you have a shopping center on it, it provides great income today, but there's a higher and better use sometime in the future, 10, 15, 30 years from now, where perhaps you can go vertical, add density to the shopping center, and Crombie's done a good job of that. This is a name we own in our fund today. It's got a nice 6% distribution yield. It trades at a far wider discount to net asset value than Choice, for example, the stock I talked about previously. We think there's a lot of upside in terms of closing the gap. And what we really like, notwithstanding this being a very defensive business, it could almost be very boring. Crombie's done a very good job of having higher than average same property NOI growth and FFO growth, bottom line growth. So it's pretty impressive what they're able to do in a business where you typically have long-term leases and very low contractual rent increases. So if you own it, I would continue to own it. We think this is a good spot to be unit holders today.
Generally speaking, are grocery REITs then a defensive move? Would you say that a general line of defense, if investors want to go that way, they can do that?
Yeah, if it's necessity-based, absolutely. But you have to own real estate that houses the dominant retailer in that node, meaning you want to own the number one or number two grocer. People don't typically shop at the third-rated grocer down the street. You want to have the best corner, the best egress, and coming into the property, things like that. So we really get granular in terms of the grocery anchor shopping space because there's so many competitors in the space. You really want to own the best brick and mortar possible.
Okay, let's move on to Ron, who's calling us today from Edmonton. Hi, Ron.
Oh, hi. How are you doing? Thanks for taking my call, Andrew. AI seems to affect everything out there. I'm wondering if you see any sectors in the real estate world that AI might decrease operating costs and drive profits up in the REITs and other sectors. Thanks for your opinion.
Okay, thanks for the question, Ron. Interesting question. Have you looked at AI in your space yet?
Absolutely. I mean, I think it's fair to say AI is going to affect every job on the planet. So it'd be, it would have to touch real estate in some manner. We think a lot about office. Will there be a secular change, perhaps more of a reduction in space, as recent graduates perhaps don't have the job opportunities that they had previously. But where it could positively help, absolutely. If things like AI can help decrease operating costs and more operationally intensive real estate lines, think residential on the leasing front, where perhaps you can do as much as you can on a phone and unlock homes, et cetera, through an app. But where we're most excited about AI today, where it's really taking hold, is in the data center space. We own a couple names on the New York Stock Exchange, Digital Realty Trust, ticker DLR, Equinix, ticker EQIX. They own data centers. Right now, they're benefiting from a huge demand wave of all companies going to the cloud, that enterprise business. AI is only going to be a further tailwind behind this at a time where I always talk about demand and supply. So supply is the issue in this business. It is nearly impossible to get new power to data center because municipalities are putting moratoriums on providing that transmission of power to data centers because they consume so much electricity. So those that have a great pipeline that can house all these large learning language models and the power, the consumption that they take up will do well. Think Digital Realty Trust, think Equinix, and we think that's the best way to play the space in real estate.
Interesting. I wouldn't have thought about that, but that does make sense. We are going to take a quick break. We don't have any more time for phone calls or emails, but Andrew has new top picks. That's coming up next. Join us tomorrow on Market Call. Brianne Gardner will be on the show. She's Senior Wealth Manager at Velocity Investment Partners, Raymond James. She's going to take your questions on Canadian and American large caps. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Right now, Andrew Moffs joins us. We're going to go through his new top picks. We're going to start with Dream Industrial REIT on the TSX. Dream Industrial is urban distribution, but also logistics. Tell me a bit more about Dream.
Yeah, if I could recommend one warehouse stock for people to own globally, this would be the one. Dream Industrial REIT owns industrial warehouses focused on what we call the small and mid-bay sector. Think 20,000 to 100,000 square feet properties. They own them, 2/3 of their portfolio being in Canada, a third in Europe, with really a concentration in the Netherlands and in Germany. We think this is a great value name with a lot of growth built in and limited downside. This trades at a very wide discount to net asset value. There's been a bit of an overhang on industrial warehouse generally, a lot of concern coming into the year. What would happen with tariffs? What would that do to rental growth? Yes, we've seen in very certain markets rental growth rates come down. But what we see with Dream Industrial is that there's a very wide spread between their in-place leases and where market rents actually are. So even if market rent growth were to come down a bit, they still have a lot of upside. We see north of 17% upside just in their rents alone. This is a stock that has a 5.7% distribution yield. And so by our estimates, we think it's trading at a 27% discount to net asset value. So we think there's a lot of upside in the stock, and any sort of overhang that we've seen, which has held back this stock year to date, I think a lot of those concerns have dissipated in terms of how we view the economy going forward. And again, they focus on small bay, distribution facilities, last mile. We're still going to see consumption be unaffected by where tariffs might hurt the economy, which is more on the manufacturing side, the export side, of which Dream Industrial has zero exposure to.
I was going to ask you, did they end up taking a hit in April like everyone else?
They did. That's what typically happens. But if you looked at the private market, you haven't seen that same hit. So that's where we have these unique arbitrage opportunities where the public versus the private becomes heavily mispriced. And we see that today in Dream Industrial.
Okay, let's get to your next topic, which is Sienna Senior Living on the TSX. SIA is the ticker there. We've talked about the space quite a bit. Why do you like Sienna over some of the others?
Yeah, so Sienna is a great stock. They have two principal businesses. The retirement side, 100% private pay, and the long-term care, the LTC side, which is government funded. Both great businesses. I'm going to steal some from some great research at Cushman & Wakefield by Sean McCrory. He says that, if you look at the retirement side, the sector has not only sustained its recovery, it's entering a period of renewed growth. And that's what we see. He projects nationally retirement homes should hit 95% occupancy levels by 2027. Sienna projects it's going to hit those occupancy levels by year-end 2025, if not first quarter 2026. When you hit that level of occupancy growth, you typically see your margins really expand because any further revenues drop to the bottom line. The other work Cushman tells us is that age cohort of the 80 plus is going to grow 8% annually over the next 10 years. Meanwhile, supply, which has fallen off a cliff, is only going to grow at 1%. So supply and demand is in your favor to own this sector. And then if you look at their long-term care side, where they are effectively backed by the credit of the Ontario government through their residents, we've actually seen a new funding formula for new development as we convert what we call Class C beds into Class A beds, and we'll see Sienna take advantage of that new program. And so you should see above average earnings growth for this company, which is already a very high growth company.
Good to know. Okay, let's get to your last pick, which is Go Residential. They do luxury like skyscrapers, high story buildings, and primarily in New York, only in New York?
Yeah, and even more niche, the Upper East Side of Manhattan. They own very high-end luxury apartment buildings in Manhattan. They just went public on the TSX, not the New York Stock Exchange, notwithstanding the fact they only own assets in the U.S. We've kind of seen this movie before. where entities that only own U.S. assets go list on the Toronto Stock Exchange. Initially, they don't do well because Canadian investors don't typically underwrite these vehicles properly. We saw this with Tricon back in 2010, Milestone Apartment REIT, BSR REIT in 2018. They all did not hit their IPO price until 12 months later. You're seeing this digestion phase happen right now with Go Residential. What's the point? You look at the stock today, somewhere around 11.85. It went public at 15. Just to close that gap is 27% upside, while you earn a 5.4% yield for the best multifamily supply and demand fundamentals in the United States today. In Manhattan, where there's less than 1% vacancy in their market, they have 10% upside in their net operating income. As rents turn, there's been a bit of an overhang because of the election in Manhattan, with the potential for Mamdani to be the new mayor, and he's talked about freezing rents on the regulated side. The majority of Go's residential portfolio is not on that regulated side, and where they are regulated, they still have the opportunity to increase rents. So we think there's a lot of upside here. We own that stock.
All right, good to know, and thank you for making that distinction, because it is an important one when investors are considering going into the space. Andrew Moffs is Senior Vice President, Portfolio Manager at Vision Capital. Thanks for joining us today, and thank you for joining us on Market Call. We'll see you again tomorrow.